Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and today we're here to talk a little bit about where we currently sit with the market, as there's been quite a bit of volatility with respect to the vaccine news, further vaccine news this week with Moderna, and where equity markets currently sit and what opportunities and rotations we've seen from the markets as a result of that news. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education or demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with our general market update here, talking a little bit about fixed income and commodities and seeing where things have moved and where things have not. Excuse me. It's important for us to understand, where investors are currently positioning in this particular news cycle as more vaccine news or more positive news on that end comes through, and how we want to position, both from an equities and potentially some of the commodity that we typically trade. I do want to, have an update here on the COVID and mobility data, because that's really the balance here. Right now, we have good news coming out of vaccine news, but we have some pretty terrible news on the COVID front. So how do we find that balance between the two? Where is the opportunity? Is it to the upside? Is it more to the downside? That's what I really want to explore. And in order to do that, I think I want to do a full sector review of all 11 sectors, where we currently sit, taking a look at then a few ideas here at the end. And if we have a few minutes, we'll open this up for questions here at the very end. But the primary question that I want to help investors answer today is really, how do you find the balance between the optimism that we see from markets in terms of the vaccine news with the sharp rise that we've currently seen with respect to the COVID cases? How do you decide which side of the market are you on? So my name is Tony Zhang. I'm the chief strategist here at Options Play. What I want to share with you are my charts, specifically sector rotation that I'm currently taking a look at, and the overall broader markets, where we're seeing rotation in the broader markets to help you inform your trading decisions. So we'll start off with a slightly different view that we normally do. We usually don't look at the Dow Jones very much. We usually look at the S&P, the NASDAQ, but this is really where, something has changed substantially over the past week between last Monday and this Monday. Value stocks, which is better captured by the Dow Jones Industrial Index, is clearly outperforming the rest of the market. The Dow Jones Industrial Index breaking out above this 29,000 level on that vaccine news, came back to retest this level as support, and yesterday just shy of 30,000 yesterday here on the Dow. And so far, it's pulled back a little bit from that 30,000. I do expect that if we consolidate above this level or stay above that level, that Dow can continue to move higher. This is the rotation into value that we started to see as a result of this news from vaccine. So if we look down the list, if you look at the S&P 500, not as strong as the Dow, but certainly starting to break out above its recent all-time high. And this is a new all-time high that the S&P 500 put in after the Pfizer vaccine news quickly gave back most of those gains, but as yesterday continued to start moving its way higher. And right now what it's doing, it's consolidating above this 353 level. And it could potentially start to push out above that 365 level. If we get a breakout above 365, that puts equities in a much more bullish state here. Now, the last index to look at is the NASDAQ 100 index. This is the index that has brought us along all market rallies since the coronavirus, leading the markets higher by a large margin. But since the coronavirus, over the past few months, it has largely lagged behind. And as you can see, even on the Pfizer news last week, on the Moderna news this week, it has failed to break out above this 296 recent high. It's still a far cry from its August highs here. So NASDAQ clearly falling behind, technology shares falling behind. We are starting to see this rotation into value that many investors have been talking about for months. It feels like we've been talking about it for years, but we're starting to see this materialize. The question is whether or not it can continue, but so far, over the past couple of weeks, we have seen an acceleration into this value play. And small caps have continued to join in on this rally. Small caps, one of the strongest. It was stronger even before the vaccine news was coming out, breaking out to new all-time highs, well above the August and September highs, new all-time highs on the Pfizer news, and new all-time highs here on the Moderna news. So small caps seeing quite a bit of strength here, and also equal weight, S&P 500 equal weight, outperforming the market weight index. This is not something that we see very often. We only saw this off of the coronavirus lows. We saw this going into the June and July lows, highs, if you will. And now we're seeing it again. So this type of outperformance is a strong indicator of the health of the market rally. So for those of you that are asking yourself, is this market rally sustainable? When you look at this type of rotation, when you see the rotation into value, into small caps, into equal weight, that is usually a good indication that the equity rally that we're seeing has legs and can continue moving higher. Now, we have seen continued outperformance here outside of US. The US domestic equity markets was one of the strongest equity markets globally, but we're starting to see Asia, we're starting to see even Europe start to outperform the US, partially because the US has, we'll talk a little bit about in terms of the rising number of cases is going to put a bit of a cap here on the rally. And I think this is really what's causing the consolidation. Yesterday news on Moderna, I think most investors were expecting the markets to rally substantially. We didn't see that. I think it's partially because of the backdrop of the rising number of cases that we continue to see here in the US. But if you look at Asia, that's not the case. That's why we're still continuing to see EEM outperforming US domestic equities. On the flip side, gold is really losing its shine here. And despite trying to rally higher here off of this triangle, it's still trading inside of this triangle. And from my perspective, I really think gold here has lost its shine here for a lot of investors, and investors are seeing other places to potentially put their investments rather than gold. And this is something that I see more of a grind, maybe sideways, rather than a breakout in one way or another. I'm not necessarily looking for a big move in one direction for another. The dollar hasn't moved substantially lower yet also, which is also leading to, the lack of this rally, and is more likely just to trade sideways here for gold at the moment. When we look at fixed income, this is really what's interesting as well, because fixed income markets also providing us with a signal that there's plenty of risk appetite from investors. HYG, high yield fixed income bonds, outperforming treasuries. So as you can see, HYG breaking out recently above this $85 level, breaking out above on vaccine news, coming back to consolidate, and now starting to move higher here. This is the type of price action that we typically look for on a breakout. And then when you factor that and look at the other side of the equation, when you look at treasury bonds, this is a very clear trend for treasury bonds. A very clear downtrend here, meaning investors are selling low risk treasury bonds, buying higher yielding, higher risk, riskier bonds. This is telling us that fixed income investors are also suggesting that they are in a risk on environment. They're willing to take on this type of risk appetite. So this is further evidence that the equity rally here has legs, that this is not the last leg of an equity rally that's about to, correct lower here. You could get some consolidation. I'm not saying that won't happen, but largely, this is an opportunity to wait for dips and buy those dips from an equities perspective if we look across the board. Now, from a volatility perspective, I will say after the election and after the news on the vaccine news, I do think that we've actually entered a new normal. I would say the new normal after the pandemic was obviously increased volatility, and every time volatility got into the low 20s, it was a good time to buy. I do think that things have shifted a little bit since the election and since the news of the vaccine. I think we're entering a new normal where we're likely going to start to see some further downside here for implied volatility. And I don't really see some strong catalyst here on the horizon, with the exception of the transfer of power with the U.S. elections. That is still, I think, a concern for some investors, but it's becoming less and less of a concern. And I think we will actually start going back a little bit towards these pre-pandemic lows in terms of, I'm sorry, pre-pandemic decline in terms of volatility, because we've resolved a lot of these major concerns. Having the vaccine, having the US elections done over with has relieved a lot of this uncertainty. So I do think from a volatility perspective, the election and the vaccine changes the volatility regime that we were in. If we look at the US 10-year yield, 10-year yields, just like it's an inverse to the TLT chart, as you can see, is still on a very much uptrend here. I think we're still on target here for a move up to about 100 basis points on the 10-year. So we're getting a steepening of the rate curve. That, generally speaking, is strong for banks, for regional banks, for, it is also bad for the dollar. So these are some of the things or themes that are starting to emerge. So for those of you that are looking for financials, this is further support for that rotation into financials, and we'll take a look at that sector rotation. But one thing that I do want to point out here is that, consumer sentiment is starting to erode a little bit. And it's not a huge erosion, but it's certainly not the continuation that we were looking for on consumer sentiment. Consumer sentiment actually coming out worse than expected. And I think that's largely due to the fact that we continue to have fairly strong rise in COVID-19 cases, no matter whether you're looking at cases, you're looking at deaths, if you look at positivity rates, all of these metrics are moving in the wrong direction. And right now we have about 70,000 hospitalized from COVID-19. That actually exceeds the peak that we had here over the summer, and actually exceeds the peak that we had here back in March. This is what I think is causing the cap that we're currently seeing in this equity market rally. And I think you're not going to see some significant rallies in equities until you start to see this curve bend down a little bit here to the downside. So this is one that I'm paying attention to a lot. And for those of you that are saying, well, cases don't really matter, or this doesn't matter as much, but the problem is that it's showing up in the mobility data. We're starting to see a slowdown in mobility across the board. High frequency mobility data is starting to come down here over the past couple of weeks, past couple of months. Regardless of whether you use Google data, Apple data, the Fed data, this is all showing this slowdown. This is the concern that some people have with respect to consumer spending. Retail sales did come out fairly strong here for October due to a lot of retailer stocks actually going into Black Friday or holiday spending earlier in the season, trying to get people to buy earlier in the season. That has worked fairly well, but I wonder if that's going to have an impact going into November and December, which typically are strong months, but because consumers are spending earlier in the season, we might see some weakness going into December, November and December, which typically we would like to see more strength on that. So in order to really understand where equity markets sit, I think we need to really understand the sector rotation that's happening underneath the hood. And that's really what I want to spend a little bit of time on here. So first, I want to take a look at materials. Materials had a recent breakout here above 82 on that vaccine news. It is consolidated and trading near the all-time highs here. So it has the potential of breaking out. It does have the potential of breaking out higher here, but still, materials not as strong here, not quite getting to those highs that it reached here on the Pfizer news. So the Moderna news not as high here to the upside. So from my perspective, materials fairly strong here, but starting to lose a little bit of its strength here on the second wave of this vaccine news. So at this moment, we're still looking for this consolidation range between, I think before I was showing you accidentally a XLI industrials chart, which I'll show you next. But as you can see, material is very much in the middle of this breakout range. Broke out, came back to retest this as support, and is now trading in the middle of this range. From my perspective, I think materials is more likely going to be range bound rather than seeing that breakout here to the upside based on the relative strength that we're seeing here. Compare that to, let's say, industrials, which is looking a little stronger here. Industrials is the one that broke out above that 82 level all the way to 88, came back to retest this as support, and is now back up to that 88 and is on the verge of breaking out. Now, if we do get that breakout here, that is a much more bullish phase for XLI. So industrials looking stronger here than materials for those of you looking, try to see where there's going to be more strength here between the two sectors. If we look at communications, this is one that also has been fairly strong, that has been fairly weak over the past couple of months. In communications, we know was very strong off of the coronavirus, as there's a huge shift to working from home and the necessities for everything from bandwidth to streaming and all of that, that communications took advantage of. And basically since the September highs, communications has really started to fall behind the broader markets, but over the past couple of weeks started to come back to life here. And as you can see, it hasn't broke out to new all-time highs, but it is testing these double top highs, and it's potentially breaking out to the upside here. So communications, flip-flopping a little, getting a little weak here over the past couple of months, but starting to gather a little bit more strength here. So this is one that I would pay attention to, but if it fails here at this double top, then this could be, continuation of its weakness here, which fundamentally makes a little sense as we reopen. There's going to be less needs for streaming, but going into winter, especially with the number of COVID cases that are currently out there, I think that there's still a fundamental thesis for this breakout. When we look at XLRE, the real estate ETF, this is the one that I think is really deceiving because it looks like it's starting to break out to the upside. But the one thing that I want to point out here, as basically since June, this ETF has made no progress, which means that relative to the market, this is a sector that's declining. So even though you have a little bit of strength here and starting to break out here, from my perspective, all that's doing is just shifting it a little bit, but it's not a true breakout because this is a sector that's continuously underperforming the broader markets by a wide margin. And you might see a little bit of a breakout, but is more likely to fail and continue moving lower here, especially if equity markets fail to move higher. This is one of the sectors, one of the weakest sectors in the market, which makes sense. Real estate, clearly not a strong sector here at in the current moment, and likely will be an underperformer here in the broader markets here for potentially years to come. When we look at XLY, the consumer discretionary, this is one where we're seeing a little bit of strength here, but as you can see, it's a very slow grind here, and actually continuing to sort of underperforming the broader markets here over the past couple of weeks, because as the equity markets shot up to new all-time highs, came back to retest and starting to retest new all-time highs, as you can see, consumer discretionary failing to break out above these recent highs. Is this a signal that this is potentially a top here for consumer discretionary? This is potentially the start. It can catch up and break out and start to continue moving higher here, but the weaker relative strength here certainly points us to a lack of momentum here and a lack of interest from investors in this particular sector. I think investors are looking more towards that industrial sector, looking at even communications as a stronger sector than consumer discretionary. When we look at XLP, this is one that's interesting because XLP, unlike XLY, has actually broken out here to the upside. And I think this also speaks to the reduction in mobility as people, as we get into the colder months and we're not going out to restaurants as much, and maybe there's even more restrictive lockdowns or restaurants are not as open or available in the places that you live, that you might be spending more time at home and buying staples. And this is the type of breakout that we're starting to see here and emerge from this rotation. So staples actually stronger here than consumer discretionary. I'd like to see a bit of a consolidation and a continuation higher to confirm this move here to the upside, but certainly we're starting to see more strength out of consumer staples versus consumer discretionary. So a lot of rotation here going on under the hood as you look at the broader markets. We see there's strength here in the broader markets, but there's plenty of rotation. So as you try to position yourself for the broader move here to the upside, this is really where you want to make sure that you spend some time looking at this rotation so that you're positioning optimally for a breakout or a continuation higher here. If you're looking to buy the dips, look at these sectors. Make sure that you're aligned with the sectors that are actually seeing strength from this, from the vaccine news and the rotation that we're currently seeing. One segment of the market that has really come to life here is utilities. And one thing I will point out here, utilities broke out here well ahead of the vaccine news. It's been strong since the beginning of October. We had the breakout above the $63 level, came back to test this level as support, and has continued moving higher here. And the thing I want to point out here is utility is moving higher in a higher rising interest rate environment. This is even further a strength for this particular sector, because rising interest rates is, generally speaking, a headwind for this sector. So when you have rising interest rates and utilities breaking out higher, this is showing you there's quite a bit of strength here. Now, for those of you that really dig into this, you'll see that some of it is driven off of the there's quite a few big utilities that are outperforming the sector by a huge margin. There's also renewables that are falling into this category that are driving a lot of that strength here. So within the utility sector, there is also a large disparity between some of the utility players versus others. So within the sector, you can also find some strong winners here. American Waterworks. So when you're looking at utilities, this is one that I do think is worth paying attention to for the strength of the equity rally, and for long-term investments. There are some interesting names here within this sector, but this is one that is really outperforming the markets, and this is one that's not on most investors' radar in a recovery, in an economic recovery. These are usually not the type of stocks that you look at, but utilities, interesting relative strength. When we look at healthcare, healthcare has really, just off of the March lows, been one of the strongest sectors, and then over the past pretty much 8 months have been falling behind the broader markets. On the vaccine news, it did break out to the upside, came back to retest this as support, but has really lost a lot of that strength and hasn't continued to gain that strength and move higher here. So the all-time high here around this 114 on XLY, I really would like to see a breakout here above that level and continue moving higher. And we're simply not getting that price action. XLV continues to decline in terms of relative strength. So this is one, despite breaking out here, I don't particularly have a lot of faith that it's going to continue moving higher at the same pace that we might expect the equity markets to rally at when we do see a dip, and then investors try to buy that dip and look for a breakout higher here in the broader equities. And we'll look at technology. This is another one similar to XLY, consumer discretionary, really falling behind from a relative strength perspective. Just as all the other markets, even utilities and consumer staples are breaking out to new all-time highs, technology, which has led this market rally for pretty much the March lows, has fallen behind. This is our first signal that not everything is okay with technology, that there are better places now to place your investments and your bets outside of technology. Now, can we see a breakout here above this level? I certainly think that that's likely going to happen, and we'll retest that 127.5. But I think that as equity markets continue to move higher, technology is falling behind. If you look at the NASDAQ 100 index, if you look at XLK, regardless of what strategy, which index that you're looking at, or which ETF that you're using, this is a segment of the market that's falling behind, losing favor. As equity markets rally, people are selling tech stocks and buying some of the other sectors that we're seeing that strengthen. So unfortunately, as much as it hurts to say that, technology is falling behind. Now, the other sector the last sector is really energy. And the question for many investors right now, and I think it's a good question, is, does this vaccine news between last week and this week, which has energy jumped substantially, is that a reason to now buy energy stocks, buy oil stocks, all of that? My answer is that look at this long-term chart here. This is XLE in the long term. Now, does this news change the picture here? From my perspective, I don't think it does. If you look at oil has not moved substantially since the move to the upside here. Brent, moving up to that $45 resistance level. Crude, still in my opinion, below that $42 level is significant here. So from my perspective, I think that these moves here to the upside towards this 200-day moving average are more opportunities to short rather than go long these particular stocks. That's my view, just because, again, long-term relative strength is still very weak here. And I think the writing's on the wall in terms of the move from fossil fuels to renewables. The questions that I get far more questions about electrical vehicles. There's quite a few questions here about NEO and those types of stocks. Investors have shifted. There's more money to be made in those stocks than there are in any type of energy stocks, and any type of gains that you see here are very short-lived, and they tend to be very quickly faded. So as we saw here last week, when energy jumped 15%, could not continue moving higher here until Moderna news came out and it jumped higher here. My expectation is here over the next couple of weeks, you're likely going to see energy to continue moving lower again. So long-term relative strength is still a concern here for energy. You get a short-term pop, but not a continuation higher here. So let's talk about some of the ideas that I have. And because we did a full sector review, I'm not doing too many ideas here for today. This is just meant to give you some thoughts as you look at this turnaround, as you look at these reopening trades, how do you look for opportunities and not go chasing them? Because there are plenty of them where I think that it's not worth chasing. So, the first thing I want to point out here is on the airlines. Now, and there are plenty of airlines to play, but I think the one airline to pay attention to is Southwest Airlines. Southwest Airlines, this $42 level has been a major resistance level, breaking out higher here, coming back to test this as support, and is confirming that move here to the upside. I think Southwest is positioned well for the recovery from the perspective of they're taking this opportunity. They have plenty of cash. They don't have a lot of debt. They're expanding during this time, which is the right strategy. They're not focused on corporate travel, which is the segment of the market that we think is going to take a big, big long-term hit and may not ever recover back to its long-term, pre-COVID levels. But when you look at leisure travel, we certainly expect leisure travel to eventually recover. And Southwest is really well positioned for that. So out of the airlines, Southwest is one that I like. And from a technical perspective, we just got the breakout. You just got the confirmation of that breakout. I think from an opportunity perspective, longer term, out of the airlines, this is the one that I like the best. And the other one I wanted to take a look at is United States Steel. Now, we talk about FCX a lot, some of the mining stocks, Newmont Mining, FCX, on copper, on gold mining. From my perspective, gold is no longer really in investors' mindsets at the moment here. I think equities, high yield are far better investments for most retail and for most investors here at the moment. But, industrial metals, iron ore, steel, these are ones that are starting to rally. Copper, FCX, but FCX has rallied 300% off of the lows here. So from my perspective, looking at United States Steel, this is a stock that's clearly underperformed for a long time. Started to stem its underperformance during the coronavirus, and we're just starting to see the breakout here above some major resistance levels. As you can see, this roughly $10.5 resistance level has been in place for a long time. We're just starting to break out here to the upside. This is a daily chart here on the left, the $10.5 price here. So Steel pricing starting to rebound, starting to break out to the upside. Rebar pricing starting to move higher here. So U.S. Steel, not on most investors' radar, an alternative place to look outside of the traditional mining stocks like Freeport and Newmont Mining and those types of names. So, those are the two ideas I want to share with you. And that's the type of mindset that I'm currently in, looking for this recovery, looking for this breakout trade that we're currently playing, and the type of ideas that I'm taking a look at. So with that, I want to thank everyone for taking the time out here this morning. I hope that this is helpful in giving you an understanding as to where we currently sit in the equity rally, where to look for opportunities as we see this equity market maybe waiting to break out as coronavirus cases maybe start to taper down here over the hopefully next few days, next few weeks, where to look for some opportunities in this broader markets. So with that, thank you so much. I hope you guys have a great trading day. And I'll see you guys here actually tomorrow when we do our next options education webinar. Thank you so much. Have a great day.